So Zoetis just missed Q2 revenue consensus. They came in flat year over year at $2.468 billion, but they did actually beat adjusted EPS estimates, posting $1.87.
Yeah, but I mean, that EPS beat is completely overshadowed by just a brutal guidance cut. Management slashed their full year 2026 revenue projections to like between 9.12 and 9.32 billion.
And they took an axe to adjusted EPS too, right? Dropping it down to a 6.15 to 6.25 range.
Exactly. And for you watching the ticker, the stock reaction was just pure whiplash. We saw almost 4% relief rally on earnings day, only for it to plunge 6% the very next session on heavy volume as the downgrades rolled in.
So today we are doing a deep dive into this Zoetis Q2 report based on the analyst notes and financials you brought in. Are these numbers a sign of underlying health or, just a really clever optical illusion?
Well, let's unpack that illusion, because starting with that EPS beat, when you look at the underlying mechanics, it feels incredibly deceptive.
I mean, it looks like classic financial engineering.
It is a textbook case. If you strip away the optics, their adjusted net income actually fell 2% organically.
Wow, really?
Yeah, the only reason those per-share earnings looked like a beat is because they executed $550 million in share repurchases during the quarter.
Right, so it's like slicing the exact same size pizza into fewer slices.
Basically, yeah.
The actual pizza, the income shrank by 2%, but because they bought back shares, shrinking the total pool by 6.2%, your individual slice just looks bigger.
You nailed it. And combine that artificially inflated per-share metric with some serious belt-tightening on their SG&A.
Yeah, just slashing corporate overhead.
Right, and suddenly you have a headline earnings beat that perfectly masks an actual drop in profit.
Which brings us to the business segments, where there is just a glaring divide in the data you provided. U.S. companion animal revenue, which is their core growth engine for our dogs and cats, plunged 11%.
Yeah, while U.S. livestock surged 23%. It's crazy.
Right, so livestock is stepping up as this unexpected anchor.
It really is.
Yeah.
What's driving that domestic surge are highly favorable cattle producer economics and elevated demand for products like Dactomax.
And that's driven by some specific localized disease outbreaks, right?
Exactly. And it's essentially offsetting the heavy bleeding in domestic pet care.
But wait, let me push back on that. A 23% surge is great, but is that actually sustainable?
Well, probably not.
I mean, if it's just a temporary spike from disease outbreaks, relying on cows to save a business built on golden retrievers feels incredibly risky.
That is a very fair point. And the livestock surge is, well, it's likely cyclical, not structural.
Right.
It definitely wasn't enough to save the overall revenue consensus anyway, which is why that companion animal drop is so concerning to analysts.
And the causal mechanism for that drop is pretty clear in management's commentary. Pet owners are showing intense price sensitivity and just actively skipping vet visits.
It's a massive post-pandemic shift. During the lockdown boom, people spared no expense on their pets.
Oh yeah, blank checks for the dog.
Exactly. Now, with inflation really biting, budget-conscious consumers are actively trading down from premium treatments to generics.
Which we see heavily in their key dermatology franchise, right? That dropped 16% globally.
Yeah, generic competition is winning out because people simply can't stomach the premium price tags anymore.
So to defend their market share against those cheaper generics, management is aggressively deploying targeted rebates and promotions.
Which, directly cannibalizes their own pricing power. They're sacrificing margins to keep volume up.
So if you're holding Zoetis, you're probably wondering, is this a permanent structural crack or just a cyclical dip?
And that is the defining bull-bear debate in the notes you're looking at. The bears argue Zoetis is becoming a value trap.
Right, with the eroding margins and lost pricing power.
And a serious credibility gap. I mean, management issued its second consecutive guidance cut in just 3 months.
But the bulls see an opportunity in a historically cheap valuation.
Yeah, they are trading at a trailing PE of around 12, which is a massive discount compared to its historical median of 35.
Plus, you have heavy insider buying and a robust pipeline with 12 potential blockbusters waiting to launch.
And management knows they need to execute on that pipeline to survive. That's why they just appointed Jay Saccaro to a dual role as CFO and COO.
Giving him the operational control to actually navigate these headwinds. But here's where it gets really interesting for you listening. Let's step back from the Zoetis specifics.
Okay.
Pet healthcare has long been viewed as this highly resilient, virtually bulletproof sector.
Right. The old adage is people feed their dogs before they feed themselves. So if a historically recession-proof sector is suddenly showing deep structural consumer budget stress, I mean, what does that signal about the actual health of the broader economy?
Yeah, it's a massive red flag for consumer spending as a whole.
It's absolutely something for you to mull over as you look at your own portfolios.
Spot on. Thanks for joining us for this deep dive, and make sure to follow the show for your daily earnings coverage.